Welcome to Breaking News to Trading Moves. Today, we're looking at the latest filings from Berkshire Hathaway. Specifically, we're going to be analyzing some recent portfolio adjustments that, well, they've really caught the market's attention.
They certainly have. We're scrutinizing a major allocation, one that's centered on a large technology commitment with a heavy focus on AI.
So our mission today is pretty direct.
Exactly.
Yeah.
We want to give you the analysis that outlines how the market is interpreting this right now. Which stocks are seen as the beneficiaries. And on the other side, which ones might be facing some pressure as a result.
And the headline fact here really sets the stage for everything we're about to discuss. Berkshire disclosed a brand new, pretty substantial stake in Alphabet. That's Google's parent company, of course. We're talking about roughly 17.85 million shares.
And that position is valued at, what, about $4.9 billion based on recent prices?
A very large number.
Yeah, and the market's reaction was pretty much instant. The news caused Alphabet's Class A shares, that's ticker GOOGL, to rise over 5%.
Pushing them to new all-time highs.
Right. And this single action, putting nearly $5 billion into one company, it really frames how institutional capital is now looking at the whole AI landscape.
Okay, so let's get into the context here.
Yep.
Because a move of this scale into a top tech firm is, well, it's pretty rare for Berkshire, isn't it?
It is. This isn't their usual territory. Right. We're used to seeing banks, railroads, insurance companies.
So why now?
Well, the timing is crucial. This allocation is happening while they're carefully trimming other positions. And at the same time, Berkshire is sitting on just a staggering record amount of cash.
I saw that number. It's approaching $189 billion.
A huge pile of cash. So the firm is making a very deliberate choice here to deploy almost $5 billion of that into Alphabet now instead of, say, leaving it in cash or adding to their old favorites.
That decision really forces you to reevaluate the whole thesis, doesn't it? What does this tell us about the current race for artificial intelligence?
It signals a strong preference for a certain, what's called a flavor of AI exposure. I call it value AI.
Value AI.
Yeah, because when you look at the major players in AI, you're often talking about companies with extremely high valuation multiples. Think NVIDIA, ticker NVDA, or Microsoft, MSFT.
Right. Companies where a lot of that future growth feels like it's already baked into the stock price.
Precisely. This investment sort of points to Alphabet as a comparatively cheaper way to capitalize on the AI boom. They have the talent, the research, the massive infrastructure with Google Cloud.
So it's a valuation play.
At its core, yes. If you look at the earnings multiples, Alphabet just trades at a lower figure than NVDA or MSFT. This move suggests Berkshire sees a lot of underpriced value in Alphabet's AI potential, especially when you measure it against those other high-flying names.
I get the price-to-earnings argument, but let me just challenge that for a second. Alphabet has regulatory baggage, right? The complex structure with its other bets. Are we sure this isn't just buying a discounted stock that has its own risks, rather than a pure vote for the best AI play?
That's a fair point, and that's almost certainly part of why there is a discount in the first place.
Okay.
But from the perspective of a value investor looking for a durable competitive advantage, a moat Alphabet has one of the deepest moats in tech with its search dominance. That generates so much cash flow.
So the cash machine is the key?
I think so. The allocation signals that Berkshire believes the cash machine is more than enough to fund the AI work and, buffer against those potential regulatory issues. It's a conviction bet on the durability of the whole business model.
That clarifies the focus on durability. Okay, let's move on to the direct consequences. Alphabet is obviously the immediate winner here.
Oh, absolutely. The multi-billion-dollar stake is a powerful form of institutional validation. And we're talking about both share classes, Alphabet Class A, GOOGL, and also Class C, ticker GOOG.
And this is more than just a general thumbs up.
Much more. It specifically validates their current strategy, their AI capabilities, the growth in the cloud business, and just the incredible consistency of their search cash flows.
That kind of approval must attract a really wide range of capital. It's not just the usual value investors following the filings.
And that's the key to the market reaction. This action pulls in, I'd say, 3 distinct types of market participants at once.
Okay, who are they?
First, you get the traditional long-term investors who follow every move this firm makes. Second, you have the momentum traders who just chase these big headline allocations.
And the third?
The general AI bulls. They see this as the moment Alphabet's AI efforts got, sort of, full financial market validation. All 3 are converging on GOGL and GOOG.
So beyond that direct investment, capital usually moves pretty quickly to re-rate peers with similar traits. Who else benefits from the positive spillover?
Well, you'd look at other mega-cap AI platforms with similarly strong fundamentals and big cash positions. I'm thinking specifically about Amazon, ticker AMZN, and Meta Platforms, META.
I'm a little skeptical on the spillover for AMZN and META. Is that really market validation, or is it just momentum traders lumping all the big AI platforms together?
I think it's more nuanced than that. The rationale is more structural. I mean, if a major investment firm puts nearly $5 billion into an AI and cloud platform like Alphabet, it confirms a broader thesis that these cash-rich platform companies, the ones essential to AI infrastructure and digital ads, are solid long-term holdings. It pushes back against the idea that this is all just short-term hype.
So it's about the durability of the business model itself.
Exactly. The conviction in Alphabet validates the platform model in general, which naturally benefits companies like AMZN with its cloud services and META with its ad infrastructure.
That makes sense. It reframes it. Now, what about the winners inside the firm itself? You call it the portfolio effect.
Right. This brings us to Berkshire Hathaway itself, ticker BRKB, and some of its core long-term holdings like American Express, ticker AXP.
How does buying a new tech company help BRKB's own stock price?
Well, deploying that capital shows the firm is still able to adapt and execute these bold, high-conviction bets. This commitment, especially after sitting on so much cash for so long, can really improve sentiment towards BRKB itself as a vehicle for growth.
And what about an established name like American Express, AXP?
It's an indirect benefit. By making a headline-grabbing tech purchase, it draws attention back to the overall portfolio strategy. It validates the long-term compounding approach, which is just exemplified by companies like American Express. It lends a renewed focus to AXP within that universe.
Okay, we've laid out the beneficiaries. Let's get to the other side of the trade. The company's facing pressure from investors rotating their capital.
This is where it gets a bit more complicated, because now we're talking about some very well-loved, long-time holdings. The first group under pressure are the ones Berkshire has actually been trimming.
And these are major names in their portfolio.
They are. The filings clearly show they've been reducing their stakes in two giants, Apple, ticker AAPL, and Bank of America, ticker BAC, all while initiating this new Alphabet position.
Let's start with Apple. Trimming AAPL, which has been such a massive success for them, that has to be seen as a negative signal, right?
You have to look at the rationale carefully. It's not necessarily a condemnation of Apple's future. For an investor with a portfolio that size, Apple had become a huge percentage of their total equity holdings.
Because it grew so much.
Exactly. So trimming Apple could just be seen as prudent risk management, reducing concentration risk. It's like taking some chips off the table, not necessarily signaling a belief that APL is about to decline.
So it's about portfolio construction, not company quality. What about Bank of America, BAC?
The trimming of BAC, especially when combined with that growing cash pile, could be read by the market as a subtle hint of caution about the upside in large banks in general.
Okay.
If you're trimming financials but not putting that cash right back into other financial services, the market reads that as a less enthusiastic outlook for the whole sector, especially compared to tech.
And what's the practical result for a trader seeing these moves?
It kind of creates a derating signal. It encourages some investors to rotate capital. They might think, well, if one of the world's most disciplined investors is trimming these old favorites, maybe I should follow that money flow, into the new position, into GOOGL.
And the second group feeling pressure are those higher valuation AI leaders we talked about.
Exactly who you'd expect. NVDA, and Microsoft MSFT. Because the analysis points to Alphabet trading on a lower earnings multiple.
Right.
It sets up a very clear relative value trade.
A trade based just on the valuation difference in the AI space.
That's it. Traders might prefer this value AI play through GOOGL. It encourages them to take some profits from the most expensive names, rotate out of NVDA and MSFT, and move into the comparatively cheaper GOOGL for their AI exposure.
And finally, the third category, the big U.S. banks as a kind of sentiment read-through.
Yes. When Berkshire trims BAC and lets its cash reserves grow, the market tends to extrapolate that caution to the wider financial sector. If a firm known for its expertise in finance is showing less enthusiasm for BAC,
then sentiment might cool off a bit for others.
Exactly. Investor sentiment might cool a little for other major U.S. lenders, names like Citigroup, ticker C, and Wells Fargo, WFC.
So it's not a direct sell signal on those names, but more of a subtle dampening of enthusiasm across the sector.
That's a perfect way to put it. It introduces a note of caution that can weigh on perception, even if those other banks aren't directly in the filing.
This analysis really gives a comprehensive view of the market mechanics. So to summarize quickly, the core action is that nearly $5 billion investment in Alphabet, GOOGL. The market then establishes a list of beneficiaries. Alphabet, other platforms like AMZN and META, and even Berkshire itself, BRKB. On the other side, you have stocks feeling pressure, like existing holdings, AAPL and BAC, and high-valuation tech names like NVDA and MSFT.
Then the takeaway for you, the listener, is really to understand the institutional rationale behind these capital moves. It shows how one strategic choice, deploying capital here versus trimming it there, creates movement across completely different sectors.
From tech platforms to financials.
Exactly.
So, as we wrap up, here's a final thought for you to consider. How might the market react to the next major Berkshire filing, especially if we see that cash pile continue to grow while traditional financial holdings are reduced even further? Does this signal a long-term pivot away from finance and towards technology?
That dynamic, cash hoarding versus targeted bets, that's going to dictate a lot of market movement, especially in the financial sector, for a while to come.
The crucial point to monitor. Please remember, this discussion is purely the opinion of the author of the material we reviewed. This is not financial advice, nor is it a recommendation to buy or sell any of the securities mentioned. Thank you for joining us for Breaking News to Trading Moves.